𝐏𝐫𝐨𝐝.com, the go-to source for the latest insights and analysis on the energy commodities market. Led by two industry veterans, Bill Shanahan and Brian Pieri, as they host their weekly commodity market recap. With over 55 years of combined experience in the energy sector, Bill and Brian bring a wealth of knowledge and expertise to the table. From trading and hedging to finance and optimization, they have seen it all and are here to break down the latest market trends and share their insights. So sit back, relax, and get ready to dive into the world of energy commodities with Bill and Brian on EnergyRogue.com.
Folks, Bill and Brian here with Energy Rogue, looking at our weekly update. And we always forget really to introduce ourselves and who we are. So Brian and I have been in the business for a very long time. And Energy Rogue is a company and a service that we established in 2021 so that you could begin to solve the problem of knowing what data to get, where to get it, and what does it actually mean, as opposed to just staring at data. So that's what we do. So today we're going to be talking about natural gas, where it's been, where we think it's going, and why we think it's going there. So Brian?
I have a very boring presentation. No, actually, listen, we are live. If you have questions or comments along the way, please drop them in the comments and we will try and get to them live. There's a lot to uncover there. And just to piggyback on what Bill was saying, Energy Rogue, we established this to understand energy markets because there's a lot of questions around price, supply, demand, imports, exports, storage, what that means for today and what that means for tomorrow. And that's why we put everything inside of Energy Rogue that gives you an interactive viewpoint into various components such as supply. I'm just going to pick on this for a second and we'll dive into this on the presentation, but all of our charts, you can actually interpret some things and some dynamics. For example, we've had a lot of discussion in our community about Canada because Canada has been growing production in Canada, but it's also translating to imports. And those imports, what's that going to do? Well, when 𝐏𝐫𝐶 comes on, it's going to translate to a different experience. But we put all these charts into a base service of Rogue Edge for $89 a month. And then if you want a little personalized guidance, as well as access to our Discord channel where we talk about the markets every single day, and you want your questions answered by Bill and myself, that's $179 a month. And many people that subscribe at these levels, they believe we should be charging more. We're trying to keep this, we're trying to keep it affordable and trying to keep it valuable for you. So did I miss anything there, Bill?
No, I think so. But I think you finally figured out that, we really enjoy what we do and we think it's valuable. And you know what?
Well, I should hope so because I'm laying it on pretty thick.
Holy shnikes, it worked.
Yep. So today's theme is Tommy Boy, and then when we're talking about energy markets, a lot of people think, well, you got to have a bunch of smart people.
I know, they're called doctors.
Yeah. So we are not doctors, and none of this is trading advice. All of it is our own opinion. There are disclaimers down below, so feel free to reach out to us if you have any questions and ask comments along the way. We're going to talk a little bit about natural gas. Natural gas has been on a journey, and that journey went all the way from $10 in 2022 down to $1. What did we get to? $1.80, something like that.
Yeah, I thought it was $1.74, but okay.
Okay, maybe you're right.
Well, I should hope so because I'm laying it on pretty thick.
So let's dive in. Let's go through this. Okay, from the viewpoint of 2024, this is a chart showing what journey we have been in 2024. We went all the way down from actually earlier this year in February, we touched 160. So that it was a
Yeah,
dollar
see?
60. Yep. And then we bounced all the way up to $3.20. We came back down and now we're down in the low twos. A lot of people are questioning why. So in 2022, we saw $7 to $10. Why was it so low? It was so low. Look at this historical. You know,
I know.
this is what's fascinating. Hey, good afternoon, Richard. Good to see you. Good to see you. Always great to see you. So when we look at natural gas, you can see that after 2022, we just dropped down to this $2 to $3 level, even sub $2, and that is, in my opinion, it's way undervalued because if you look at the raw supply and demand, which we're going to get to. So commentary, where we are today, which right now today, I'm actually going to take this over and say right now we have been dropping today. Tomorrow is storage day. Today is Wednesday. And we did go all the way from 211 this week, all the way up to 225. And I actually personally think that we have a 231 target, but today's weakness might be an indication that we have some challenges. And another reason that we have some challenges is a new website that we actually created. We are going to have a weather product. And if you look at the population weighted cooling degree days, we have been dropping. So a lot of people ask, well, why has natural gas been dropping? If you look at the forecast is dropping. So that is where we are. We're about 213, 213.8, 214. What are key bearish risks in your opinion, Bill? You're on mute.
Hurricanes have always been a impact. When we had a lot of production in the Gulf, hurricanes were a supply destruction. Now they've become a demand destruction where we don't have as much production coming out of the Gulf. Most of the production's on land. So it's actually going to affect the markets as much as much more than it will the demand. Now, I've seen some big stuff coming out in the Gulf right now as far as deep well on gas. Huge, there's big wells out there that they're talking about, and so it could switch back. But I mean, the biggest thing is that the hurricanes are going to affect one. It's going to affect the markets on the U.S. Number two, it's going to affect the shipping lanes, though those
Right.
interruptions will probably be only a day or two, and they're a little bit more versatile. It's hard to move markets, but the ships can't go around hurricanes. It just adds to the cost of what's on their cargo. And so those are the two main factors that hurricanes do. So the last one we just saw that came through Houston, the biggest demand destruction it had is it took out power lines.
It took
And so
out power
people,
lines to Freeport.
right, to big power lines, not just to the LNG, but also for the demand.
Right.
And so at a time when the demand was high, if it came in and the temperatures were 75 degrees, you're not going to see that big a demand destruction. There'll be some demand destruction, but
Right.
not that big, because when we talk about in the summer, we're talking about air conditioning. That's the big demand on natural gas, which by the way, that power demand has been going up by about 3 to 4% every year on the natural gas side, not just total power, but on the natural gas side. So hurricanes is number one. It's the most unpredictable bearish thing. Then I think really once you get through that, as Brian's going through the LNG ship outs, and then the next thing will be a third week winter. And so, gosh, it's almost like, oh, it's weather, which is why we came up with WX weather, Energy Road weather. It's why we did that. And so you need to be able to track that weather and see what's going on, and you can do that on our deal.
This is a completely free site, by the way. WX Rogue and these forecasts are automatic, and they go all the way out to August 28th. So they go out 7 days, and there are by regions, by cities, and population weighted degree days. And then we have forecast by NOAA. So it is a very helpful resource that many people like out there. We are developing a paid product that will be inside of that. For those that really want to get deep into understanding the energy.
And you can get a lot of that weather commentary in our premium product, where we actually have a Discord channel that's strictly on weather. And Brendan's out there helping us every day, trying to figure out what's going on, the trends are going to be, where it's going to be happening. And he's always creating maps and showing us all different squiggles on the United States that represent
This is
either
awesome.
high pressure,
So
low pressure.
the one to the left is the cooling degree days, and you can actually see on a color map how it's going to change. So that
And
is actually
if you
fascinating.
don't know what a cooling degree day is, man, when you join, Brendan will explain it to you. The cooling days and heating degree days, and why it's important, and how they
Yep.
look at it. And we love to think that everybody always agrees. That's just something I learned from him, is that, well, the heating degree days and cooling degree days, they have a starting point, and not everybody agrees on the starting point.
Right.
So it's interesting to understand the nuances of what you're looking at, to understand whether what you're looking at makes any sense.
Yep.
So
And
that's just one of the many benefits of being on our premium product.
Yep. So then flipping sides to the bullish risks, there's bearish risk and bullish risks, and we try and look at things. Permian natural gas growth has been tapered because there is wide speculation and a lot of rumors that Permian is entering tier 2 acreage. And for those that don't know, that means less oil, more gas in the economics, because when you look at the economics in the Permian, you can start with this map right here. So natural gas price is what, $2.13, $2.14, right? Waha is minus 223. So Waha, or West Texas gas, which is the Permian, is negative. It is priced as a negative, it is clearing as a negative, and it is priced that way in September. So if the Permian utilizes natural gas as a waste product to really get the crude oil at tier 2 acreage, means there's going to be less oil, which their economics are going to go down, and more gas, which means they're going to be exposed to that negative, which is going to drive dropping rigs even further.
And realize some of those wellhead numbers have gotten to a minus 450 in the last month.
Yeah.
So that's pretty significant, paying people $4.50 to produce your own gas. So
absolutely,
that's a big deal.
Absolutely. So then if you look at, and the reason I talk about Permian, Utica, and Haynesville, those are the most prolific areas of natural gas and natural gas growth. And again, this is part of the reason that when we look at the supply side of the equation, we look at what is driving each particular basin. And when we look at Permian, Haynesville, and Utica, you can see a massive growth, but you can also see that we're kind of tapering off. And a big reason why is because Permian went from 11 BCF to over 25 BCF a day. So if the Permian contributes less gas to the equation, that's going to put more pressure on Utica and Haynesville to fight off declines. The marginal rate needs at least $4 to really get there. And currently, we don't have the economics to really support adding rigs there. Rigs are just fighting off decline, and drilling rigs have been dropping ever since mid 2023.
And the rigs dropping are not all about efficiency. It's about market. because the efficiency has improved. Actually, I've seen as high as 16% improvement on rig efficiency, and the number of feet perforated, which is
16% from when?
16% from its peak. So from about the 700 range, they've been seeing. I think I would say that's 16% over what we were seeing in 2019. How's that? We'll just use that for the number.
Okay, so in other words, they've improved the drilling efficiency, the volume that we get out of one rig by 16% since 2019, something like that.
Right. And so let's talk about how they do that rig efficiency. Brian, we had this conversation last week. Is that what they'll do is they'll use the total number of rigs out there and total volume produced.
Right.
Well, if you're bringing on ducks, you're giving rig efficiency to rigs who didn't deserve it.
Right.
Because they had a lower efficiency back when they drilled those ducks and didn't get to production. Now you're getting production without the rigs. And so you have to be careful about watching your rig efficiency. And so most rig efficiency is based on how many days it takes to drill how many feet. And so it's time versus foot drilled. That has anything to, and so when you start trying to assign production to that, that's sort of apples and oranges. And so, but it is a factor. You can take a look at it, but I wouldn't put a whole lot of weight on it just because of the way they calculate it. So it's all about market.
Well, put a different way. If rigs drop 30%, but our efficiency drops 16%, then we don't have a 1-to-1.
Right.
So
and most likely we'll never have a 1-to-1, but that's okay because there's other factors. This is what being subscribed to Energy Road helps you. It's never one thing. It's multiple things. And we look at all those different things to help you get an accurate view and a holistic view of the energy market.
Yep.
Such as going back and seeing what the price was years ago.
Yep. And that's one thing that we talked about recently with one of our clients. And what we did is we compared 2024 on the natural gas prices versus 2020, which was COVID times, versus 2016, which was one of the toughest times for upstream oil and gas producers. And 2024 is the worst that we've seen it from a price perspective. And you can paint a picture, and we're going to paint a very different picture than what is on the table, because many people project that natural gas is just going to be down here for so long. We actually have a different viewpoint.
At least the cost has gotten less, right?
What's that?
At least the cost to drill a well is cheaper. Oh wait, no, it's not.
It's not. It's actually, it may be cheaper on a per foot, but then when you go a third of the distance longer, it's not cheaper. So, so that's what's interesting. So now a lot of people have talked a lot about supply, but natural gas is about to enter a new phase. And what is that new phase? It's going to be driven by LNG, Mexico, and power. These are achieving new highs. Power added 2.8 BCF on a week-on-week basis last week relative to last year, 2.8 BCF a day. So if production is up a BCF a day and power is up 2.8, Mexico's up a B. LNG is going to add another 2 BCF a day. Add into that there is news that Canada is going to go into phase 1 and take LNG shipouts in 2024. So when you add this together, it means that the United States, the North America with Canada is going to be more interconnected with TTF and JKM. And as you can see right here, TTF and JKM are about $10 higher. When you extract out the absolute costs, Henry Hub is going to be more exposed to these markets. And even if they just get a sliver of it, that adds $1 to the baseline for Henry Hub. At just a sliver of it. Because LNG in the next 12 months is going to increase by 6 BCF a day. Let me say that again, 6 BCF a day in the
So,
next 12 months.
Brian, can you pull up that chart on you got our system up? Pull up our chart on the production scale for the last few years.
Oh,
Supply, yeah.
this one?
Yeah, that one, but more importantly is showing, yeah, that one right there. So when you look at this and say what our peak was, so let's say, what was the last 2 years?
The
We'll start
last
in
what month? What
just pick it from 2 years from today. It doesn't matter. Just last 2 years. I'm looking at the amount of growth, not when it is.
So August of 2022, we were at 98.1 BCF a day.
And we went to 103.
And
as a
August
peak.
of last year, we were 102.5. August of this year, we're at 101.3. So we're actually beneath last August right now.
So what I'm saying is that it took us 24 months to stabilize at about 6 BCF more. But yet in the next 12 months, we're going to have 6 BCF more of just LNG.
Right.
So do you think it's getting easier to drill? We're getting better at drilling? I don't think so. So what I'm saying is that we're seeing demand beginning to outrun supply, and it's not today, but it could very well be in the next 12 to 18 months.
Actually, I'm going to argue with you. It is
Okay.
today. It is today. You want to know why? When you look at this right here, last week, we withdrew from storage in August. When's the last time that happened? 2006. Last time we took gas out of storage and withdrew during the summer was 2016. So think about that. It's 2024. The last time we withdrew from storage during the summer injection season was 2016. And the last time we did that in an August was 2006. What is very important to remember is when you look at natural gas and you look at natural gas pricing, you have to look at net supply and demand. And when we look at this chart, this is one of my new favorites. Every time we come up with a new chart, it's my new favorite. So this is my new favorite.
So just to let you folks know, what we do is when we develop these charts, we're looking to tell a story. And so we're looking for the data to tell us a story. And I think this particular chart tells a story that a lot of people are ignoring.
Yep. So here's what we have here is if you shave off these peaks and kind of go with the meat, we are getting smaller on it. We're taking off the peaks, but our supply versus demand, we're shrinking. That means that we have so much demand, it is soaking up all the new supply, and that is super important. But add into that, we're going to add even more demand, and that demand is going to dwarf what we've already added. So let's add this up. We've already added 5 to 7% in demand over the last 3 years. LNG is going to add 6 BCF a day, or over 6% more in the next 12 months. Mexico is set to add 1.5 BCF, or 1.5%. Power is going to add, I say, likely 3+ BCF a day. When you have AI, when you have data centers, that is continuing to fuel 2.8% versus last year right now, and we're growing even more power. That is 10.5% of demand in the next 12 months. So that is going to take so much of our supply offline. Yes, we have a lot in storage right now, but seasonally corrected. Let's see, did I cover that here? Let me see if I covered storage. Because if not, I'm going to segue for a second.
I don't think so.
No, I didn't. And no, I didn't. But The reason that natural gas is down so much is because when we look at storage, let me pull this up. This is what we've been watching versus the 5-year maximum. In March, we were over 330 BCF over the 5-year maximum. We're now inside of the 5-year maximum. We're going to see where we are tomorrow. I think we're actually going to get closer to the average, but we have been communicating with our membership that by the when we started the injection season, we said, you know what? I think we're going to end up the storage injection season pretty close to the 5-year average, which means that we will have made up over 600 to 700 BCF in storage inventory. Now, one big reason that we created so much inventory is really tracing all the way back to Freeport in 2022. So production additions, mostly from 2022, most of this is because of the rigs that we had in 2022. So today we're at 101.3 BCF a day. Of course, I misspelled that. BCCF. I wonder what that is. Let's make up a new acronym. What is a new acronym for BCCF?
Brian's constantly confusing figures.
I know. They're called doctors.
So anyway, how did we get here? Well, from the COVID trough, where all the rigs were abandoned, dropped, and left alone, we recovered and we grew our rigs by 300%. Well, that 300% actually translated into a supply-demand imbalance, and that's where we are. But then that created price weakness. That price weakness represented the reason why we're down 24% off those highs. So declines are also going unnoticed. We decline over 3.6 BCF a day. Every single month, we need new wells to replace. New production growth is growing. You can see this trend right there. And what does the future look like? It looks like this. We have less than 250 right now. Less than 250, actually 213, 214. But if you look in January of 2025, you're at 350. So that means within 5 months, we're going to be there based upon the futures contracts.
And so based on what you just went through there, what we need is about 113 BCF a day of production. So we have to grow production by 10 BCF. And that's not something that's easily do. The last time we grew it by 10 BCF is coming from the 90s to now, almost. If I remember right. Am I remembering that right, or 2001, 2003 somewhere?
And I think it was 2001. I think it was 2001.
So in other words, it took us 20 years to grow it by 10 BCF, but we need to grow by 10 BCF in the next 24 to 36 months.
Well, and let's actually look at the supply, and because back to 2017, we have grown a lot since 2017, but it hasn't been a straight line. So since 2017, we're at 70 BCF. So we grew 30 BCF in what, 7, 8 years?
Yeah, but that's because we created the shale.
Yeah. Well, we didn't create it.
Well,
I think your brain has a thick candy shell.
It's got M&M on it, though. Sometimes it's a WW.
Yeah.
So this is not. It's not going to be an easy task, and if you look at it, people say, "Well, we have renewables." Well, renewables, they maybe can grow 3% a year, maybe, but right now they've been losing. So
if you look at this is our power stack for the United States. And what you can see is everything in green here, that is natural gas. This is on a daily frequency. We do have an hourly frequency that updates, and it works. but you can see nuclear, coal. What's fascinating is somebody mentioned, well, we're going to get rid of coal. And I said, I heard that in 1995, and it still represents 20% of our power stack. So, so the thing is that renewables are growing, but look at the colors. And let me take off water, and let me take off other, and let me take off oil. So now you can see the blue is coal. This down here, this is coal. Okay. This is nuclear. This is natural gas. And right here are renewables. So renewables have been growing, but not to the scale needed for power. And this
The
is
demand,
why,
right?
yeah, this is why when we look at the power demand for natural gas, what you will see over time is, yes, renewables are growing, but our electricity usage is growing faster than renewables can really take hold. So even if we grow just a little bit, you add in some data centers as well. They need consistent supply, and renewables aren't going to be consistent on an hourly basis, and that's where it becomes a tricky challenge.
That's why you're seeing these new data centers trying to locate close to nuclear power plants.
Right.
But realize that that doesn't make the nuclear power plant create more.
Right.
It just means they got to take it back from somewhere else.
Yeah. Yeah. So
So
now
you'll have
let's.
a great search engine. You just won't be able to access it from your house because you won't have power.
You figure you put that little box under your pillow at night, the guarantee fairy might come by and leave a quarter. Am I right, Ted? What's your point?
Exactly.
So so now let's look at pricing. So what we've talked about today is that supply is facing some uphill battles. Demand is continuing to grow and at a faster rate than supply probably can spin up. So when you match that together with the current price deck, I think 2025 all the way out to 2029 is mispriced right now. Again, this is not trading advice. This is we're not financial advisors. You can read the disclaimers down below, but this is where I see a misallocation and a mispricing of natural gas, and I probably see us resetting a lot higher. Now, when you can you can book a meeting with us. There's a link down below. There's also, hey, a nice little natural gas trading, how to approach natural gas trading. There's a free webinar down below in the link, and that is about a 40-minute long session that we cover everything you want to know if you are trading natural gas. But my outlook is very, very positive, very constructive. The fundamentals need time to catch up, but storage is showing that the fundamentals are catching up in a big kind of way.
I'm not sure if we've been insulted or complimented.
What do you mean?
Well, that sometimes you just want to go,
We're so American.
yes.
James, good to get. Yes, we are so American. You gotta love Tommy Boy though. How can you?
Oh yeah, absolutely. Yeah.
How can you avoid that?
Holy shnikes, it worked.
So, so listen, yeah, I love it too. I can't get enough of Tommy Boy. That's actually one of my favorite movies. But if you look at the raw fundamentals on the supply demand basis, and we are looking at this, and let me get back to the other slides on the presentation. Here we go. Power added 2.8 BCF a day since last year. I'm projecting 3 BCF a day between this year and next year. I think our power growth is going to dwarf that. 1 BCF a day of growth just in the past year on Mexico. LNG added 2 BCF a day to the baseline, it isn't fully utilized on the capacity side. LNG is going to add 6 BCF a day. But if you look at this, we are set to add 10.5 BCF of demand. Now, is all of it going to come online? Is that like when we have the LNG capacity, does that mean there's going to be ship outs? Don't know. So I'd say at minimum, we're looking at 5 to 6% growth at minimum. So if we look at that demand side, the demand side is going to lead. The supply side is already seasonally correcting itself. But I also want to point out something on the supply side. U.S. gets a lot of gas from Canada. This is Canadian imports. So if you look at this, we kind of have a range of, say, call it maybe 6 BCF to 4 BCF. And you can see we have particular ranges. This was a relatively colder period, and there was also some curtailments during COVID. But what you can see is that we get about 4 to 6 BCF a day. And something that was mentioned in our Discord channel, let me find it. Astro, if you're listening, I'm going to steal your article. This one. Analyst says LNG Canada likely to start exports before year end. Right. That is over 2 BCF a day of Canadian supply that is going to be going to LNG exports. So 2 BCF a day, we're going to get less imports from Canada, more exports via LNG, more exports via Mexico, more demand via power. This is a recipe for a lot of hyper volatility to the upside.
That's right. And that LNG coming out of Canada is going to compete with us in Asia, and they've already got just a mileage advantage.
Yep.
So
and listen, I've got one other thing, James, if you're still listening, because we try and do this every Friday. Hopefully you'll join us.
Oh, and remember, next Friday is Hawaiian Shirt Day.
There we go.
There you go. I think you can lean into that with your proximity to the beach. So that is pretty much it that we have today. Are there any lingering questions you have, Bill?
Yeah, I've always wondered this, Brian. Why do we drive on a parkway and park on a driveway? That's just always confused me for a very long time.
No. Strike me down in anger and I'll always be with you.
There's the dad jokes. So listen, folks, thanks so much. Thanks for spending time with us. We went on for about 38 minutes and we talked about it. Hopefully you found some value. If you found some value, hit the like, comment down below. We try and get back to all the comments. All that really, really helps. So please help.
If you're on YouTube, be sure to subscribe.
Yes. And feel free to reach out to us personally if you have some questions, if you have some comments, and you really want to understand some things about the energy markets, reach out down below. We're here to help you because we want to help you on your journey. So I think that is all that we had for today. Let's see, Richard, at least a better outlook for the next 12. Yeah. Richard, I actually, we should talk offline. We should have another meeting, but because I think it's not only going to be a better outlook for the next 12 months. This is a massive investment opportunity for anything gas related. So that's my opinion. Not financial advisor. This is not investment advice. Read all the disclaimers. So
please, yeah, I mean they're great. They cure insomnia. So. Yeah. Folks, listen, we're glad you joined us today. We really do enjoy doing this. We also really enjoy the comments that we get back. And we'll be looking to talk to you a little bit next week.
Yep. We're going to talk to you next week. And listen, folks, thanks so much. And I hope you have a fantastic day, and we will see you soon.